Okay, we've now moved to part 3 where we're dealing with transportation. Yes, all the fun expenses that are dealing with transport. Now, a little bit more involved and it seems than it was with inventories. And that's true because, again, inventory is more of a accounting issue. But certain transportation expenses for business purposes are deductible by taxpayers. And this basically includes travel by plane, rail, or bus. So, trains, planes, and automobiles. Great movie. Should see it if you haven't seen it. Good comedy. Anyway, the cost of operating and maintaining an automobile is also a deductible expense. But that has its own caveats, and we'll go and talk to those later on. So, transportation expense may be deductible even if taxpayer is not away from his or her tax home. That is true. Okay? We're going to look into how that is possible. So, this is where we got commuting going on. Okay? So, when we look at commuting, and we have to get away from the whole deductibility, is that commuting in itself is generally not deductible, except in the following 3 circumstances. This is where we got the home deductibility. Travel between taxpayers' home and work locations outside the metro area where taxpayer lives and normally works. Basically, you go into a different work location. So, say you work in Houston, but they want you to go out to, Beaumont. Well, that's not your typical work location. So, you get to actually take that travel. Nice. Travel between taxpayer's home and temporary work locations if taxpayer has regular place of business. Again, that's a temporary work location you're going to. R3. Travel between taxpayer's home and other regular or temporary locations if taxpayer's home is his or her principal place of business. This is our people that work from home kind of thing. Yeah! Woo! In all cases, taxpayers can deduct additional cost of hauling tools and equipment. So, yes, that added fuel and so forth and so on. Trailer, we got that. But here is going to start coming the kicker. Okay? So taxpayers can use the standard mileage rate to calculate deductions of transportation expense. And when we look at the standard mileage rate, this is currently set at 57.5 cents per mile. We have to keep an eye on the IRS as they do change this amount every year. So next year it could be more, it could be less. Right now it's following a trend of lowering a little bit every year, but every now and then it does spike again and then slowly just trickles down. Now, these are the following costs that are associated with operating an automobile that is built into standard mileage rate. Basically, these are items that we are not able to deduct if we take the mileage. That's gasoline and oil, insurance, repairs and maintenance, and depreciation. Notice that there is a few missing. Where are the missing? Well, this is what's missing. These are deductions that we can take that does not fall under the standard mileage rate. Basically, it allows us to take with the mileage. This is, of course, your parking and toll fees related to business transportation. interest on car loans. So if you do have a car loan on it, you can take the interest on it. Surprisingly, yes, it's awesome. So buy a new car, make it a part of your business, and boom, you get to deduct the interest off of it. Personal property taxes. So those you have to be more particular about when you do your registration. There should be actually taxes that are associated just to the weight of your vehicle. But it will always say personal property taxes. Okay. So, how do we use the standard mileage? Well, you have to qualify. And one, you have to own or lease the automobile. It has to be your vehicle. That's simple. Two, not operating a fleet of automobiles. Basically using 5 or more simultaneously. So their fleet is 5. If you're using 5 or more vehicles on your Schedule C, well, you cannot take the standard mileage anymore. Not have claimed depreciation on an automobile using any method other than straight line depreciation. That's a key. It's the only time that we can switch from actual expenses to the standard mileage. So, only using straight line. And I'll tell you this, that's hard because if you've ever put depreciation on taxes, and we're going to talk about depreciation, it automatically does it as makers, which can actually eliminate that, and you can use standard mileage. So always be careful. And fourth, you can claim Section 179 depreciation or bonus depreciation. So basically, if you've depreciated it, odds on, you're probably not going to be able to qualify. Now, if the taxpayer does not use standard mileage method in first year, it is not available for any subsequent year. Ouch. Yeah, that's true. You cannot change back and forth. You cannot do that, so it's either take either or. I will tell you every tax person will usually tell you to take standard, because typically we end up traveling more than whenever the actual expense of the vehicle. Just think about it. If you're actually traveling with the vehicle and you do 20,000 miles, about 57, I mean, you definitely know you're over a $10,000 deduction already, because that's just half of it. So you're looking at probably $12,000 of deductions. Man, that's almost a vehicle, especially if you bought a cheap vehicle. That's why we typically go standard. Standard mileage. Yes, do it for all. Now, you can choose to deduct actual expenses of transportation. Again, not usually advised, but we'll go with it. Taxpayer may change from standard mileage method to actual cost method in any year. So we can do that. If change from standard mileage method to actual cost method is made, you must use straight line depreciation on the automobile. And basically, it's gonna change a lot. I'll already tell you that. Sometimes you probably won't even have depreciation left when you change. But taxpayers who use the actual cost method must keep adequate cost records. So mostly if you have QuickBooks or any other accounting software, you're going to be keeping adequate cost records. The same thing with you taking standard mileage. You got to keep a mileage log. Simple as that. Now the following formula is used to calculate deduction when using actual cost method. You have to take the actual expenses and multiply by business use percentage. which is basically business miles driven divided by total miles driven. This is for any vehicle that's not 100% business. You can only take the percentage that's actually for business use. So, again, you can also say standard mileage is a little bit quicker. Takes a little bit more time to do actual. And you end up coming out still less than your actual mileage in the long run. Mileage is always key. So, this business use percentage is applied to total automobile expenses for the year. So, gasoline, oil, repairs, depreciation, insurance, etc., etc. Now, again, tolls, parking fees, interest on car loans, and personal property taxes are separate. Okay? And then vehicle expenses are reported on Form 2106 or 2106, whichever way you want to say it, and are carried over to Schedule C of other forms. So when we look for Form 2106, let's see if we can go ahead and find it. So minimize. Let's go to here. And we're looking for Form 2106. Always on the IRS. And again, the good old instructions for form. Any form you can find on IRS. There we go. Here's our form. So here's our vehicle expenses. So expenses, parking fees, there's all the other fun stuff, any other travel expenses, and then business expense not included. Then we have to deal with meals, and we'll talk about how to deal with meals. But basically this is the form that they want us to fill out anytime that we're using expenses. And the mileage one, we could have done right there on the Schedule C. See? Right there. Business, commuting, other. And then just ask you a few questions. But you can actually compute everything right here. And it actually tells us to file Form 4562. But you know I'm going to go ahead and show you 4562. And then here's Form 4562 for depreciation and more amortization. You can tell it's late when I make a video. But this will actually list all of our depreciation, which we'll get into. But it will also show vehicles, usually right here. Vehicles, vehicle 1, 2, 3, 4, 5, 6, so forth and so on if we need more. But it's a nice little form nonetheless. Okay, back to the PowerPoint, because we have a knowledge check. So, slideshow. Oh, this one's a pretty easy one. So again, you can look at it if you haven't already seen the answer, but which of the following costs is built into the standard mileage rate? Is it the good old depreciation? The parking and toll fees? How about that interest on car loans, or maybe the personal property tax? Pause and figure it out. Okay, so using our great knowledge skills, we know that depreciation is built into the standard mileage rate. The other three are completely separate items that we can take no matter what, no matter which method we choose. Okay, so that concludes transportation. A little bit about vehicles, good old mileage. So, if you have any questions, again, you know what to do. And I'll see you for the next part where we start talking about travel.